Fundamental analysis is the process of examining a company's financial statements to decide if its stock is a good investment. Financial statements include balance sheets, income statements, and cash flow statements. This information helps determine the financial makeup of the company behind the stock. In this video, we'll explain how fundamental analysis uses these statements to help evaluate a company. Let's start with the balance sheet. This document compares the company's current assets to its liabilities and owner's equity. Let's define these terms. First, we have assets, which are items the company owns and have the potential to provide future value. Assets are usually comprised of cash, equipment, and property. Next are liabilities. Liabilities are usually debts or accounts that need to be paid. Often a liability on the balance sheet has an offsetting asset that helps the number stay level. For example, if a company were to take a loan out to buy a property, the loan would be a liability and the property would be an asset. The third term of a balance sheet is capital or owner's equity, which is the amount of assets raised by issuing stock. For example, when a company issues stock either in its initial public offering or in a secondary offering, it raises money or capital that can be used to fund various business expenses. Balance is achieved when the value of the assets are equal to liabilities and owner's equity. The balance sheet helps you see how a company raises money for its assets and can help you determine if the company is overextended. However, if you want to know how the company earns money, you'd look at its income statement. An income statement shows a company's revenues and expenses. These are the costs associated with running the business, including operations, interest paid on loans, and taxes. When you take revenues and subtract expenses, you get net income. Net income is the earnings of a company. Earnings are usually handled in two ways. The first way is to share the earnings with shareholders by paying a dividend. The second way is to reinvest these earnings into the company. Reinvesting earnings can help a company's cash position. A company with a good cash position is usually better prepared to endure economic ups and downs. This is why investors say, cash is king. It's also why the cash flow statement is so important. This statement shows how the company uses its cash to operate the business and make investments. It also shows how much is borrowed from a bank or bondholder. These figures are totaled to show changes in the company's overall cash position. This statement is important because it gives a more detailed account of how the business generates revenue and is therefore much more difficult to manipulate than an income statement. As you can see, there is a lot of information in the three financial statements. With all of these facts and figures, analysis can be a little tricky. This is why investors may use ratios. There are several ratios that can help an investor compare stocks, but we'll focus on one of the most common, the price to earnings, or PE ratio. Let's say you have one stock that costs $6 a share, another at $35 a share, and a third at $132 a share. How would you know which one is the best value? You might assume the $6 stock is the best value because it's the cheapest. However, this might not be the case because a company's value may depend largely on the company's earnings. The PE ratio allows you to look beyond the price of a stock to see which company could be the best value. To create this ratio, first divide the net income or earnings by the number of outstanding shares. This number is called earnings per share, or EPS. Next, divide the price of the stock by the EPS to get the PE ratio. The first company is trading at $6 and has an EPS of 20 cents, resulting in a PE of 30. The second company is trading at $35 a share and has an EPS of $1.40 for a PE of 25. The final company is trading at $132 per share and has an EPS of $3.90 for a PE of 34. Now you can better compare each company by its PE ratio. Despite the drastic difference in stock prices, all three companies have a similar valuation. However, the second company has the lowest PE ratio and may be the best value. Remember, a PE ratio is only one of several ratios that can be used. There are other ratios for determining valuation, profitability, and financial strength. There are also other figures to examine in financial statements. We've only scratched the surface of fundamental analysis in this video. It's important that you learn more before using this analysis to make a trade, and we're here to help you every step.
There's a lot of investment lingo out there. Do you ever feel like you don't know where to start? Let's tackle two of the most basic investing types you should know: stocks and bonds. Let's start with stocks. When a company needs money to expand or grow their business, they can sell stock to the public. In exchange for that money, the investors, the people who buy a stock, now own a piece of that company. Investors can make money on the stocks by buying them when they have a lower value and selling them when they have more value. Investors can also make money by sharing in a regular payout from the company to its shareholders, something that's also known as dividends. Not all companies pay regular dividends, but when they occur, dividends and changes in share price are both part of a total return, which is your total gain or loss on an investment. What about bonds? When you buy a bond, you're actually loaning money to a company, government, or government agency. The money is typically used for things like construction and other projects. During the life of the bond, an investor typically gets paid interest at steady, predetermined times. Interest is basically the money you are given by the borrower in return for lending them that money. At the end of the loan's life, the borrower returns the principal value of the loan. You can trade bonds in the market just like you can trade a stock. Bonds are considered more conservative investments than stocks, but they also typically have lower total returns. So what did we learn? A stock, a share in the ownership of a company; a bond, an interest-earning loan you can make to a company or a government.